Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Marati, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today. So Dan, in terms of that first question, I suppose considering what the world looks like at the moment with inflation, interest rate pressures and everything happening in the world, where do you guys or where does Lonsec see kind of share investment happening in today's market?
Thanks, Martin. Look, at a high level, I mean, from a sector perspective, the value and cyclical oriented sectors do tend to outperform in an inflationary environment, and that's because the businesses within these sectors tend to have a higher earning sensitivity to higher interest rates and inflation. And these sectors, examples include financials, resources, and energy. So natural resources and financials are some of the key sectors that do benefit from high interest rates and rising inflation. And at the same time, at the other end of the spectrum, the duration and growth sectors of the market do tend to underperform at these times as higher interest rates and inflation tends to have a negative impact on the relative valuation of these sectors. And that's particularly important now because we've just enjoyed over a decade of ultra low interest rates and inflation, and obviously that's changing as we speak. So we're seeing a rotation between these sectors, these two factors at the moment. And on that side, from an example, sectors include technology, healthcare, and defensive growth sectors like consumer staples are underperforming. And the key part of the reason for that is once again they're being grouped in that growthy quality bucket, which is being devalued or derated because the market is pricing in certain expectations for interest rates and inflation. And they don't tend to benefit as much when things are not going so well, and at the same time when interest rates are rising and the economy is strong, the businesses are still tend to do well. So this is purely a derating from a valuation and an underlying sort of momentum in market sectors.
And so that's not saying, I suppose, arguably they're less profitable, but it's saying there's less growth in that space, or like on that, like if. So Coles or Woolies, the price of things are going up. Well, surely they'll pass on the consumer, but effectively their margins being into, or they think the consumers will just spend less.
Look, historically speaking, inflation has been a positive for the supermarkets because they tend to have the capability of passing through those price rises, and obviously on absolute terms, it's positive for their sales growth. And particularly given the dominant nature of the two key providers in the Australian market. So look, the margins are getting impacted, but there's a number of reasons for that. It's not just inflation. There's been COVID-related costs coming to the system. There's lack of available labor in some pockets of the market. So, but it's not dramatically impacting their margins. So overall, as a basket, if you look at the technology, the healthcare, and the staples sectors, there are no real negative impacts from an earnings perspective. These are really solid, strong businesses. Some of them benefited through COVID, some of them not as much. But these are solid businesses that are not reliant on the underlying macro economy to do well. And as we saw, those two sectors did really, really well during the drawdown in the pandemic. So basically what's happening is the lower quality companies tend to need a stronger underlying economy to do well, whereas these businesses don't. So what's happening is that there was a flow of money into these sectors in the lead up to this period or in the last decade per se. But now, because there's tangible evidence of higher interest rates and inflation, the valuation multiples the market is prepared to pay for these businesses is reducing. And that's what's driving the underperformance.
So, Dan, in terms of the holdings that Lonsec currently has in particularly the direct side of the portfolio, what I guess, shares do you think will perform well, and which ones do you think might not perform as well in this cycle we're entering now?
Sure. Look, I think from a even from a holistically perspective, as we saw sort of this environment developing over the last 2 years, we've made sort of gradual moves in terms of adjusting our portfolios. Obviously, we've had more tangible evidence in recent times that the extent of inflation and the extent of potential tightening by central banks. And the first part of the portfolio that we needed to adjust was the bond allocation. Obviously, given that's not a positive tailwind when we've got rising interest rates and inflation for that asset class, and to combat that, we maintained our underweight exposure to that part of the market, and introduced active managers to manage the interest rate and duration risk. But on the equity side of the portfolio, once again, we've gone through all the holdings that we've had in the portfolio to make sure they're not negatively impacted by what's happening from a bottom-up perspective, and obviously how they would fare in a scenario of inflation and rising interest rates. And basically, it sort of goes down to factor exposures within the portfolio. We've given the quality bias that we've had. We usually have overweight allocations to the quality parts of the market, your healthcare, consumer staples, your stronger growing companies, and an underweight position to your volatile cyclical businesses like resources, which have a lack of visibility from an earnings perspective. So we don't want to have too much of the portfolio exposed to that, to those segments of the market. But what we've done over the last 2 years per se, we've gradually upweighted exposure to the major banks. As I said, financials should do well in this environment, and higher interest rates is good for bank margins. And they've fared pretty well throughout COVID. So that's a sector that should do relatively well. We've increased our cyclicals exposures within the portfolio. We've added companies like Computershare, Suncorp, and Cube, which are businesses that are most cyclical, that have upside leverage to their earnings because of higher interest rates. In terms of Computershare, in terms of the massive cash float that they have in their business, which will benefit from higher interest rates. Insurance within Suncorp should do well in an inflationary higher interest rate environment, and Cube being a proxy for economic growth in Australia, once again should do well. And at the same time, what we've done is try to lower the exposure in the portfolio to the defensive growth sectors of the market that have done quite well in the last couple of years. We've removed Coles from the portfolio, maintaining the Woolies exposure, and we've sort of reduced our healthcare exposure in terms of just trimming positions and taking profits in the likes of CSL and Sonic Healthcare that have done quite well. Once again, nothing wrong with those businesses from a bottom-up perspective. It's more about the group of companies that we have exposure to in the portfolio, to make sure that that we have some increasing embedded inflation protection in the earnings for these companies that don't lag too far behind in such an environment. And we can continue to make adjustments depending on what the outlook for that inflation is, because initially it started out as being a transitory issue because of COVID, and now there's other factors that have come to play. So it's just about actively managing the portfolio to get through this phase.
Dan, just on that, like those, I definitely seen some of those changes, and like, are you referring more to the core or to the income, or a bit of both?
Just purely the core, in terms of, obviously that's the flagship product that feeds into the multi-asset portfolio as well. So it's from that perspective. The income portfolio does have a higher exposure to bond proxies and more mature businesses, as you would expect in terms of dividends. So we can have a higher collection of growth stocks in there, but bond proxies suffer in this environment as well, because once again, they've had the tailwind of 10 years of low interest rates, being a positive factor for valuations. And now, when you can get 3% on a 10-year bond yield, a 3% dividend yield on an infrastructure stock is not as attractive. So that's what the market has derated. Once again, nothing wrong from a bottom-up perspective. It's right now the biggest factor in the market is relative. It's the underlying fundamentals is less important. It's what's relatively better at this stage, and that could change at any time if the outlook for interest rates or inflation changes.
Another item that interests me, Dan, is the current exchange rate. I know recently I've heard some economists talking the Australian dollar down based off of I guess trade with China potentially being curtailed a bit with different geopolitical issues. But what's actually happened is that wheat, oil, gas, iron ore, all those things have gone up, and which has driven demand for the Australian currency. So I'm just curious about your perspective on, I guess, how the Australian currency might affect earnings that are being repatriated back from, say, the US, in the likes of companies like Amcor, who do a lot of their trade over there.
Yeah, look, currency is always an issue. Look, as you guys know, the Aussie currency is interest rates and commodities are the key drivers of the Aussie, and obviously what happens with interest rate differentials between our market and the US market. And obviously the outlook in an inflationary environment, the outlook for commodities is strong, and the RBA is going to be raising rates pretty quickly soon. So that should be positive tailwinds from a currency perspective. But I guess from a portfolio perspective, look, currency remains a very difficult area to predict, and in the short term, it's the movements are close to random. And so taking a long-term view is very important in this regard. From a portfolio perspective, we have a strategy called the strategic hedge ratio that we monitor across our portfolios, and also that sets out the optimal long-term FX exposure in our portfolios from an asset class perspective. Now, look, it's important to note that from a currency perspective, hedging has historically had a limited impact on portfolio returns. If we look back historically, the long-term returns for a hedge portfolio and an unhedged portfolio have been very similar on a longer-term time frame. But what it has an important impact on the short-term volatility of the portfolio because of those currency movements. So to manage this across as a portfolio level, we sort of implement the hedge ratio on an asset class level. So our Aussie and global equities, we tend to have them as unhedged. And from a asset class perspective, the lower volatility asset classes they need more hedging. So your global property, infrastructure, and global fixed interests, we tend to have them as hedged exposures, and the rest is unhedged. From a direct equities perspective, we do have a combination of businesses that earn a lot of the earnings from foreign sources. You got your CSL, some of the healthcare businesses, ResMed, which is a US-based business, and Amcor, which is businesses all across the globe. So, and it's not just one currency that impacts it. So it's the euro that impacts the Amcor, for example, the US dollar that impacts CSL and ResMed, and it depends on where they get their earnings. So net, I think it's more about, once again, not having all the portfolio exposed to one factor, in terms of just being aware of where our currency exposures are. We tend not to have a huge call on currency in terms of the Aussie going up and Aussie going down. And the earnings tend to look after themselves. We're more focusing on the ability of the company to grow its earnings, and the currency becomes secondary unless we're at extremes like the dollars at 50 cents or as dollars over parity. And this is historical extremes that we can make a more educated estimate in terms of where the upside risk and downside risk are.
Dan, what's your view on the growth versus the value argument in our current positions now?
Look, obviously we've sort of touched on the sectors that tend to do well in an inflationary environment, which was obviously your cyclicals and values and sort of the duration and growth stocks not doing as well. And obviously in the short term, we're seeing that the value sector outperform growth, and it has done by a very significant margin over the past 6 months. But overall, from a medium-term to long-term perspective, I do think superior returns can be generated by investing in high-quality businesses that can maintain and grow their earning streams over the long term. And that obviously falls into the growth basket versus the value factor, where these are lower quality businesses, more volatile earning streams, and earnings are more exposed to the underlying economic cycle and the macro settings, not just upon the position of the business in the industry. And obviously from a growth perspective, from a quality perspective, we have and have embedded that factor in our investment philosophy and our portfolio construction process. Where over the long run we have a bias towards allocating towards quality and growth businesses and sectors, because I think over the long run those businesses will do well. So once again, in the short term, it's about just actively managing the portfolio and recognizing the fact that things have changed. I mean, we've had these settings that have favored growth since the start of the GFC, where we've had sort of unusual monetary policy settings, and now because of the pandemic and then some geopolitical issues, the value sector has come to life after 14 years. But once again, it's the growth of that sector is fragile, and as soon as that sort of dynamic changes, that sector will go out of favor again. And once again, where do you go? You go to quality businesses. So I think it pays to be biased towards that factor, which is what we tend to do in our portfolios over the long run.
So really over the next 12, 24, 48 months, that you're really looking for more of a value-orientated portfolio, and then once it's kind of settled and established, then you'll probably jump back into the growth aspect of it?
Look, it's our primary investment philosophy is quality at a reasonable price. So it has to be a quality business. Now, we're not going to chase some of these high momentum businesses. You know, you got your small business, single earning stream, or financially challenged business that just happens to do well. So that's not within the mandate or the style of the portfolio. But what we're trying to do is recognizing the fact that times have changed. And what we've tried to do is just shift the portfolio and introduce exposures that are still good businesses, and that also as a benefit tend to do well in this environment, and hence the inclusions of the likes of Computershare, Cube, and Suncorp into the portfolio. We've had Elders, which is one of the cyclical businesses that we added last year. So these businesses will do well, but it's not businesses that you want to hold for the very long term. So, for example, CSL is probably the highest quality businesses, one of the highest quality businesses on our market, and it hasn't had a great time over the last 12 months. It's pretty much gone sideways, whereas the market has gone up. But because we've got confidence in the quality of that business, we're happy to hold it through this sort of phase of the market, because we know we're happy to, if nothing changes, we're happy to hold that business for the next 10 years. But for some of these other cyclical businesses that need the macro to go their way, well, we're not happy to hold them for 10 years, but we're recognizing that we need to basically diversify the portfolio and enhance diversification just to get through this current phase. And then when things change, we can reassess.
And I think that's something we've been saying to clients lately, Marvin, is one of my go-to lines: when the facts change, so will my mind. But also, taking into account the fact we're going into a completely different environment, sometimes you do need to change your mind about the particular stocks you're holding and how that economic environment might impact.
It is. I think that the energy sector is a classic example where the market's chasing it. It's done fantastically well in this year. I think up about 25-30%, because oil prices have gone up because of what's happened overseas. Now, the structural headwinds for oil are still there in terms of fossil fuels and renewables and the long-term change in the demand pattern. So it's not something that you want to be holding for the next 10 years without sort of a lot of ups and downs. So you got to see what you're chasing in the market in short-term moves, because they're in the headlines, and those earnings are not sustainable. So if the oil price was to go back down to $80 again, which it may well do so in the future, well, the share prices and the earnings are going to go down with it, versus CSL's earnings or Woolies' earnings are not going to go down to that extent, all things being equal, obviously.
And I guess that goes to the point of Lonsec's philosophy, and I think it's very much closer aligns with our philosophy, that it is a buy and hold type of strategy. We're not trading in and out of stocks and buying this bank this week and then selling it next week because that bank's a better price and trying to make 10 cents here or there. But on the other side, it's not just buy a share now, keep it in the drawer for 30 years and never look at it. We do need to tweak and adjust and manage risk along the way. I suppose, do you want to give us a bit of a rundown about from a holistic point of view, Lonsec's approach and kind of like, the turnover that we're trying to aim for, and kind of what the philosophy is around the portfolio generally?
Sure. Look, the philosophy around that core portfolio, once again, it's quality at a reasonable price. That sort of simply means we look for good businesses that the valuation makes sense to us and they can grow for the long term. Ideally, we want to buy a business and not sell it, but obviously the depth of our market doesn't allow to have an entire portfolio of that mold. We've got to have diversification in the portfolio. So we don't want to have, just because quality, healthcare is quality, we can't have 70% of the portfolio. So we've got to make sure we've got embedded diversification in the portfolio and understanding how the underlying economic conditions feeds into some of the earnings of these businesses to make sure we have the right mix. What we do, our investment universe is the ASX 200 benchmark. We've built a number of quant models to just filter some of the key metrics of these businesses that are good sort of quality factors in terms of return on equity, the excess return on capital versus the cost of capital, balance sheet strength, gearing, debt, cash flow conversion and margins. Basically, that sort of filters out the lower quality businesses in the market. We trimmed that universe down to about 70 businesses that rank the highest within the respective gig sectors. We've got 11 sectors in the market, so we've got a shortlist in each of those 11 sectors. At that point, each of those stocks are allocated to our analysts. So we go through and conduct bottom-up research on those businesses, just to make sure that it's not just a quant thing. We want to make sure where is the quality, where is the strength of this business, is the earnings sustainable over the long term, and how can they grow. We value these businesses, so quality aspect is separate, the valuation is separate. You can have a really good business, but it just doesn't make sense from a valuation perspective to us, so we stay away from it and wait for an opportunity for the market to present that to us if that may be so. Then what we do is sort of rank the stocks in each of those 11 big sectors to have we want to own the highest quality businesses in each of those sectors. We understand, for example, that resources is cyclical and volatile, but we cannot have not resources in our portfolio, given that it's a third of the Aussie market. So BHP to us is the highest quality business in that sector because of its tier one asset classes, its costs, and its cash flow profile. And once that happens, obviously the portfolio is constructed, and our team continuously monitors the developments within these businesses. And look, the turnover is subject to market conditions. Historically, it's averaged between 25 to 30% per annum. It is a high conviction strategy, so 20 to 25 holdings. So typically maybe 2, 3, 4 changes per annum on average. During COVID times, we dialed up that turnover to some extent because we felt like it was needed. But there's been times where 18 months we haven't made a change because it wasn't warranted. Mm-hmm. Our analysts monitor the universe and our holdings. We meet with companies, we meet with industry sources to make sure that we're on top of things. And generally, there's 3 factors that could cause a transaction per se or a change. Firstly, is that there is a change in the investment thesis for the business. So something material has to change for us to obviously change our view on that business, whether it's whether it's an M&A transaction, whether it's a management change, whether it's a strategy change, a regulatory change. We assess and look at that impact. If it changes our investment thesis for that business, then valuation is less important because that investment thesis is broken from our perspective. So that requires a change. Secondly, is valuation grounds. So basically, if all the growth projected for that business is captured in the current price, that's a catalyst for us to review. But obviously, given that we're a fully invested strategy, we need to find a better alternative holding within that universe in our portfolio. So that's the other catalyst from a change perspective. In terms of obviously better risk reward exposure elsewhere in the universe, and lastly, all our decisions are sort of discussed with from a peer review perspective, and all the decisions are done either at an investment committee level. Once again, from a risk management perspective, it's not one person just making all these calls. They are all ratified in action at an investment committee level.
And you spoke a little bit there about valuation. Now, obviously, one of the things that goes into valuations is what we call a market risk premium. Many years ago, it'd be nothing to see that sitting around 10%. I think recently some my managers have been saying they've been using 5%, which obviously dramatically changes what a company's valued at. And you've seen that with the likes of companies like Tesla and things like that are valued at more than some of the, bigger, more stable car companies, just as an example. So can you talk to us a little bit about, I guess, what sort of market risk premium you're seeing, especially given that interest rates are rising now?
Yeah, sure. Look, in terms of I guess from a valuation perspective, there's three components that feeds into the valuation for equities. It's your risk-free rate, which is historically the 10-year bond yields have been used as a proxy. You've got your equity risk premium, which is generally around 5 or 6%, which is that's the long-term average. Obviously, that's the figure. It changes over time in terms of spot, but that's the sort of that's where you get your risk-free rate plus your equity risk premium is equivalent to your equity market returns, and the third component is the beta for that stock, which is the risk versus the market. Now, from our perspective, look, the equity risk premium tends to be pretty stable, so we use that 5 or 6% level. We have kept it constant throughout the period. What has changed is the risk-free rate that really is impacting the discount rates that's used to value equities. As I said, historically it used to be 5% as a proxy for the long-term bond yield, and 5% plus your equity risk premium 5 or 6%, and you get your 10 or 11% equity market returns. But what's happened over the last decade is that risk-free rate has been artificially lowered by central banks. So we've been stuck at very close to zero for a long time. So that means we can't use zero as a risk-free rate. So that number has been gradually trending lower. So what we do is basically we've got some models that take into account a combination of time-weighted historical rates across the yield curve to come up with a spot risk-free rate that feeds into our equity valuation models, and that has trended from around 5% to around 3% at the moment. So that sort of it does take into account what's happened recently, and it's been a positive tailwind for equity valuations overall. So net, if that risk-free rate is increasing, which is what we're seeing at the moment, then that is a headwind for equity valuations. And this is what we're seeing in some parts of the market, and it tends to hurt those duration equities a bit more than your lower growth businesses. But at the same time, the inputs into these factors are the long-term inflation expectations and growth expectations from an overall market perspective that determine the long-term interest rates. So if we're upgrading our risk-free rates, and because of inflation and what's happening with reserve banks, the interest rates are going up because growth is coming back. So what that means, we have to also review our long-term growth rates and our terminal growth rates, which is the other side of the equation. So if the inflation is higher and growth is coming back to the market, that's why interest rates are going up. So that terminal growth rates need to be upgraded as well. So that sort of negates or neutralizes that negative impact to some extent in terms of a higher risk-free rate in valuation models. But I dare to say I don't think too many in the market are right now using rates too far above 3.5%. I don't think we're heading back to the days of 5%, because that is once again a material difference to what's in the consensus expectations, and that would imply that our interest rates are going back to those levels from the 0% we are in now, which is it's highly unlikely according to the facts that we're seeing at the moment. It's been a huge factor in the market since the GFC, and there was a reason. Is it's supportive of asset prices and risk assets when you have basically the cost of money has been artificially low for a long time, and the reason why all these things are happening in the market right now is the cost of capital is going up. But having said that, we're at zero. Even if we go up to 1.5% or 2%, as some are saying, that's a new neutral rate going forward. In absolute terms, compared to what we've seen in the past, it's not that bad. It's not that high, particularly given the large amount of debt that's in the system at the moment. It's more than before GFC. It's higher than pre-COVID. So there's a lot of debt in the system. So as a whole, I don't think we can afford the higher interest rates or the interest rates of the past. So the new normalized rate should be lower than the past. But look, there's tail risks in terms of runaway inflation, geopolitical issues. We don't know what's around the corner. A couple of years ago, we didn't have COVID. We didn't have the geopolitical issues that we're seeing in Russia and Ukraine, and that's caused a big dislocation in markets. So there could be further left field events that could extend this phase. So that's why it's a difficult time, a challenging time in the market because of those factors. It's almost like the bottom up fundamentals have been put to the side, and these factors are taking over. And the other thing about risk-free rates is basically, I think if you're consistent across your universe, you can't use different risk-free rates for different companies. So as long as you're consistent, then you should get a relatively similar answers in terms of evaluation. So if you're changing it for CSL, you got to change it for Afterpay, you got to change it for Xero, and you got to change it for Telstra. It's the same risk-free rate. So you'll get a good sort of view on terms of what gets impacted in what way, and usually. Your lower growth businesses, when you adjust that risk-free rate, are more positively impacted because they have lower growth profile, and the longer duration growth stocks get penalized because of a lot of their earnings is in that terminal value.
Moving forward into the future, a little bit of uncertainty, interest rates on the rise, costs tightening, and people probably maybe not spending their money. What's the expectations of dividends and franking as well too from these companies over the next few years?
The dividend profile of the Aussie market has been improving. Obviously, it suffered a huge setback because of COVID in FY20, and we're making our way back. We're not quite there yet, but look, balance sheets are very strong, and that sort of feeds into the payout ratios. The payout ratios are not there yet in terms of pre-COVID, but once again, we're getting there. In terms of the forecast dividend yield for the market, I think on a cash basis, we've just tipped over 4% at the moment for next year. And then I think the franking is there's no material shift in franking. So we overall market is still between 65 and 70%. But that 4% or 4.2, I think it is now on a spot basis, it's really dominated by those big companies at the top, particularly resources. I mean, if you look at Rio, Fortescue, and BHP, they're almost at 10%. And because they've got such a big weight in the market, so that's really lifting the dividend profile of the market at the headline level. But if you look at a little bit deeper, like on an average or a median perspective, it's about 2.8. So we've still got a pocket of the market that haven't even resumed dividends because of COVID. Your casinos, your Qantas, travel stocks, none of those are really paying dividends yet since the GFC, and the resources businesses are making super profits because of what's happening there. So I do think that the industrial end of the market is likely to upgrade their dividends, and the top end of the market is likely to normalize lower, because I don't think 8 or 9% dividend yield is a normal yield for BHP and Rio. But as long as iron ore is at 150, that is a sustainable dividend. That's the unknown factor. We don't know where iron ore prices are going, and if they stay up there, then that's maintainable. So net, given the balance sheets, the confidence of management is increasing. Gradually, COVID is getting behind us, and basically the dividend payout ratios are nudging higher. So I think we've got room for upgrades coming from a dividend perspective from an overall market. And the second part of that is banks. They're a huge part of the market. The balance sheets are strong. Interest rates going up is good for their margins, and credit growth is still pretty strong on that level. So and the bad debts are very much under control. And the COVID wasn't a disaster from that perspective. So I think we'll see bank. They won't return to the pre-GFC levels, to those payout ratios, because they were unsustainable. But I think there's room for upgrades for bank dividends, which will support the whole market dividend. So I think just around the 4% is the figure that I think is sustainable.
Lately, I've noticed that the Australian market's been doing quite well compared to international markets like the Dow Jones, for example. Can you talk to us a bit about where you see the Australian market heading and why, I guess, it's performing better than its international competitors?
Yeah, sure. Look, you're right about that. Basically, I think that ties in with the other points of discussion in terms of the cyclical sectors doing better in this environment because of those dynamics of inflation and higher rates. Our market is dominated by financials and resources. That's almost 55% of the market. And they're the cyclical sectors that do well in this environment in terms of high inflation and commodity prices. So hence it's been risk on from an Aussie equities perspective. It's not common for Aussie equities to be outperforming, particularly over the last decade, because your US markets do have the higher allocation to technology. We don't have a high allocation to technology or those businesses in the Aussie market, whereas in the US, obviously you got the big four at the top there that have done really well. And that's the growth component of the market. So there's been a reallocation of funds to cyclical markets, and we've seen Japan rally, we've seen some parts of other cyclical markets in the market rally, and for Aussie markets to rally. So as long as this thematic is around in terms of rates going up, inflation coming in, I think the Aussie market should continue to do relatively better than global markets. Until there is some sort of a normalization or clarity in terms of what is the peak in interest rates and how long is inflation here for. So if the Reserve banks increase interest rates, inflation normalizes and settles down, behavior from a demand perspective gets back to normal, I think that will probably reverse course at that time.
It makes sense. So I guess that obviously, to summarise that very nicely, is that's the value of diversification. Is international stuff, and Nasdaq has done very well for the 5+ years, but doesn't mean it's always going to. So if we look in the revision mirror, it might not always be the best indicator of what's going up.
It is, and that's the whole part of the process in terms of we make sure that we've got embedded diversification at a security level and an asset class level, because you don't want to time these rotations or these swings in the market or speculate on how high interest rates are going to go or where inflation will go, because that's not our core strength, and even the experts can't get it right. So it's to combat that, what we need is diversification. Like we've had gold in the portfolio, and at the times the market goes well, gold doesn't do anything, and we don't expect it to. And we've seen this year gold be one of the best performers in the market because inflation, currency, geopolitical issues is a positive for gold. And we've felt that over the last couple of years, we need an element of that in the portfolio. And same with cyclicals and growth, they're not both going to outperform or perform well at the same time. But we've got to make sure over the long term, we want to have diversification at that level to make sure that we can gravitate towards it. And if we get higher conviction on those themes like we have now in terms of what's happening, we can adjust the portfolio if necessary.
When clients come to us and we'll work with clients, one of the big views around is yes, it's about growing their wealth and in that respect, but it's as much about protecting that wealth and protecting it from risk, so that yes, we want to get an income, yes, we want it to grow and keep with pace with inflation, but it's much about protecting that downside risk. And that's one of the things that we enjoy working with the Lonsec portfolio in particular. Often it does do that. And I think that's consistent with your methodology in thinking about the protection of risk. And I suppose that diversification is a good way to protect against that from your side of things.
It is. Look, if anything that we're guilty of is that we're too conservative in terms of from a diversification perspective, and particularly during the times where we saw after the US election, the market was up 14% in 3 weeks, and we obviously fell behind. We're not. If you're diversified, you're never going to keep up with the market when the market does the momentum moves like that in particular sectors. So basically, the way our portfolios are structured and we try to run them is that we in very strong markets we'd like to keep up with the market, because obviously usually there's different dynamics of what causes those returns. So we'd like to keep up with strong markets, but at the same time we want to make sure that we provide that downside protection to the extent that we can in those drawdowns. And I think we've been running our portfolios for a long time. I think the Aussie equities is over 20 years and the multi-asset over 10 years, and they've both been through two of the biggest drawdowns was through the GFC in 07, 08, and during the March 2020 COVID drawdowns over those periods. And I think I'm glad to see that portfolios behaved exactly in that manner in terms of the drawdown was less than what we saw in the market. Obviously, it's negative return; it's never good. But when the market's down 30 or 40%, no matter where you are, you can't stop that, or you can't predict or time that continuously. So the way we tackle that is basically make sure that we've got diversification and also act when we need to act. That's the other part in terms of, You can't just put your head in the sand and think everything's going to get well. It's about making the changes, and we don't have that trading mentality. Like, we do see some of these cyclicals rally, and we knew that this was going to happen, but it's not like, we can set a position for 3 months, and once it hits the price, so that's a more trading mentality. This is buy and hold, diversified returns based on the risk profile, with a view of getting your target returns over the 5 to 7 year time frame.